Good morning, everyone. Thank you for joining us today. My name is Mitch Young, co-founder of the Fusion Consulting Group, and we're delighted to bring you our 2023 Taxation Masterclass. What is an interesting time for business owners, entrepreneurs, families with the mortgage interest rates consistently increasing, the cost of living crisis in the UK. We felt very passionately about bringing you this masterclass to essentially provide you with some golden nuggets of information around taxation that can help you, your business, your family, hopefully save some money and save some tax. We essentially are working every single day with clients to help them be tax efficient and financially efficient. So hopefully what you get throughout the session today is some thought-provoking pieces which you can go away and action. Obviously, we're bringing you a masterclass session today, and we're aiming to provide a series of masterclasses throughout the next year across a variety of subjects. You'll see that there is a chat function and a question box on today's webinar. So we're happily entertain your questions towards the end of the session. So we'll allow about 10 to 15 minutes of questions. So please feel free to put them in the chat box or the question box, and we'll come to them at the end. Also today, we'll be doing a prize draw right at the end of the session. So there'll be someone will win this Mitch the Taxman cap. So make sure you stay around for that at the end. As mentioned, today's session is brought to you by my company, the Fusion Consulting Group. And what we're trying to do here is to provide our clients with essentially their own private office. So it's a place where they have all their key advisors under the one company, all speaking to one another to ensure that they're financially and tax efficient. So we have in-house award-winning tax advisors, of whom you're going to hear from today, accountants, solicitors, financial advisors, and we also have a recruitment arm as well. So whatever you need as a business owner or a private client, we have that all in-house, and that works very well. So today's session is going to be split into 3 mini sessions. First, you'll hear from my colleague Henry, who's our senior tax advisor. He'll be focusing around property tax and some items that we're helping our clients with around structuring and just day-to-day property elements. You'll then hear from my colleague Netsai, whom is a private client solicitor, and she'll be talking to you about business property relief, inheritance tax, and wills. And then finally, you're going to hear from myself, where I'll be talking about corporation tax, some practical elements of what we're seeing our entrepreneurs do, and I'll be finishing around offshoring and establishing an overseas entity and things to consider if you have that in mind. So the session today will be no longer than 1 hour. We will try and finish speaking around the 45-minute mark. As mentioned, please feel free to ask some questions. You'll see our contact details throughout the slides. So if you want to discuss your personal matters in greater detail, please email all of us and we can arrange a free tax consultation to discuss your private matters in greater detail. But without further ado, I'd hand you over to my colleague Henry, who will begin the masterclass.
Thank you, Mitch, and thank you for the very warm introduction. I hope everyone is doing well. I guess just a bit of an introduction from my side. So I'm a senior tax advisor here at Fusion. I'm also a chartered tax advisor. So broadly speaking, what we are looking at today is we're going to be looking at how we can effectively help you, and maybe your business, or maybe you're a property owner, help how you could potentially save some tax. So if you do have any questions as you go, please feel free to put them in the chat box. But typically, just a bit of sort of day to day, what we do is we help people with their tax affairs. So it's not just looking at compliance; it's also looking at if you're maybe someone who has an accountant at the moment, how you can be more tax efficient. So we're going to run through broadly what is tax efficiency, and I guess what areas could you look at. Of course, it's non-exhaustive list, so there might be other things which we haven't discussed today, but if we were to talk about every single chapter in verse, you would probably find this webinar would go on for a long while. So we'll try and keep it short, but also probably relevant. And as my colleague Mitch said, we'll look at property and some other areas of potential savings. So firstly, top tips for property investors. So I think when we're looking at property, I think a lot of people are either curious about buying property, or maybe they have a property and they fall into this property investor category. Now, of course, with rising interest rates, mortgages are becoming more expensive, so maybe it's less in fashion. However, you'll be surprised, the value property has gone down as a result of increase in interest rates and harder eligibility for lenders, or stricter eligibility. So what we're going to talk about today is a lot of maybe key areas you could think about, maybe if you are looking to purchase property, or maybe you are an existing landlord. So without further ado, let's move on. So I guess before I talk more about the sort of esoteric ideas, for anyone, if you file a tax return already, you probably already you know the criteria. But if you are a landlord and you or potentially want to be a landlord, a couple of sort of key criteria for you. Do you need to file a tax return? Well, most certainly the answer would be yes, you will. If you have more than £1,000 of rental income, so that's revenue, most people probably have that. If you're a part owner in a property, so say you're a joint owner with your spouse, earns more than £1,000 a year, you're going to need to file, even if there's no tax due. So usually first year property landlords, their first year, they might make a loss because of all the costs involved and whatnot. You might find you probably don't have a profit for the year. You still need to file a tax return, and that's regardless of where you live in the world. So with that in mind, just so maybe some people might not know, you're going to need to file a tax return, and that's not necessarily bad, and that's absolutely something we can assist you with. So multiple dwellings relief is a very interesting area. So this is to do with stamp duty, but I had an interesting conversation with a client recently, and their solicitor or their conveyancer who was helping them with a property acquisition didn't know about multiple dwellings relief. Now, of course, you might have a solicitor who's helping you purchase a property, but you might find that they aren't aware of these specific tax rules, because this is quite a niche area, and I don't expect everyone to necessarily fall into this criteria. But effectively, you can claim this relief when you buy more than one dwelling in a transaction, so a single transaction or a number of linked transactions, which includes freehold, leaseholds, and typically most properties you would look to buy. And the example is, if you're buying 4 houses, say there could be a block of flats. If you're buying a block of flats and there's 4 units for £1 million, you divide it by 4, so you take the average cost of each individual unit and use that for stamp duty, and then multiply that by the number of houses. So you don't look at the headline rate, you're very much looking at the per unit basis. Now, of course, for some people, this could be a huge amount, because stamp duty is quite high. And if you're buying, maybe a big transaction, this could be a very, very high figure. So be warned and be careful, because like I said, your solicitor may not know about this. So jointly owned property. Now, you could be someone who, maybe if you're married or in a civil partnership, let's say you are a higher rate taxpayer and your spouse is a basic rate taxpayer, then it doesn't make sense for the higher rate taxpayer to be the one paying the income tax on the rental profits. So typically what we can look at is moving into a joint ownership. So effectively, joint, you can either, if it's not already in a joint tenancy agreement, you can create a joint tenancy agreement, quite relatively straightforward. And this can be done tax-free if you're married. Of course, if you're not married, slightly different. There might be some tax considerations there. But if, say, you're married or in a civil partnership, you can effectively shift profit in accordance with whatever ratio you like. So let's say you're using the same example, your basic rate spouse, basic rate taxpaying spouse is they can have 99% of the profits and you can have 1%. So, very, very effective tax savings there. If you're fortunate enough to be a higher earner, and it can, for a lot of people, this does typically happen where you might look to buy more properties and you don't want the income going in your name because you're a higher rate taxpayer. So something to look out for. Next, we have, and I think this is probably one of at least the question I get a lot about capital versus income expenditure. So what that means is, if you're, say, forking out lots of money, say, you have some tenants who perhaps damage the property, or you're looking to evict, there might be costs involved in doing that. Now, HMRC are very clear about what can be deducted from the rental income, which is effectively an income tax benefit. So, of course, income tax rates are higher than capital gains tax rates, which is why this is such a hot button issue for some people, because they may prefer to have an income expense. Of course, you get the benefit now. You don't have to wait until you sell. So, of course, some of these might be obvious, but some of them may be less obvious. So, to be deducted from rental income, expenses need to be incurred wholly and exclusively for the purpose of the business and not capital in nature. So, typical hallmark income expenses are accountancy. So, i.e., maybe the cost you pay your accountant to prepare your tax return or tax advisor, estate agent fees, advertising, insurance costs, replacement. And I think that's the key word in that, replacement of a domestic item. So say you, this invariably usually revolves around kitchens, because of course fashions, trends change and tastes change. So when we are looking at someone who maybe forked out a lot of money for a kitchen replacement, we need to look at, are you replacing something that already existed, or are you building something new? So of course with kitchens, if you're keeping it aligned to technological advancements, usually that's not considered going above and beyond what was existing. However, if you're building an extension on the back of the property or on the top of the property, then of course that you're building something that didn't exist beforehand. So that would be capital, which means you would not get the income expense on your tax return. You would only get the benefit when you sell the property. So cost of travel, of course, say you have a property in Scotland and you need to inspect the property, say you live in London, the cost of traveling, you can claim. Repairs and decorations, of course, typical, if your carpet is ripped or whatever you need can be done, you can claim the income expense with that. And interest, of course, this is, a lot of people are paying a lot of money for their mortgages at the moment because of the interest rates being so high. So of course, HMRC do not want to make this too generous. So what you'll find is the finance costs are probably the least good of the income expenses that you can claim, just because you get a basic rate tax credit as opposed to a flat deduction. Of course, if you're a basic rate taxpayer, then it's not a problem. Same thing as a deduction, pretty much. But if you're a higher or additional rate taxpayer, this could be, quite expensive. CGT reporting. Now, if you say, of course, if you're transferring property from your name to your spouse's, there's no CGT reporting required. But say if you are looking to sell the property, or if you're looking to transfer the property, there is a capital gain to consider. Now, what that looks like is you're going to have to report it and pay the tax within 60 days. So that's for UK and non-UK residents, unfortunately. So if you leave the UK and sell a property or transfer a property, there's still going to be UK capital gains tax to consider. And that's going to be 60 days to report and pay. Of course, you can get private residence relief if you are, if you lived in the property, even if you lived in the property at some point. So that could be effective tax savings. Say if you lived in the property 10 years ago and you've owned the property for 20 years, you effectively can exclude the period in which you lived in the property from capital gains tax. So that can bring that down quite a lot. Of course, if you lived in the property the whole time, there's no gain, you don't pay capital gains tax on. Non-UK residential property as well. If you're, say, maybe investing in property abroad, that falls outside the scope of the 60 days. So that would be done through self-assessment. Now, this is probably one of the more lucrative ideas and maybe something most people haven't come across before, but effectively what you can do is set up a self-invested personal pension scheme, or SIP for short, and you can effectively own property in your pension. Now, the benefits of doing that is it's effectively like having a pension scheme, although, so all the tax benefits that come with that, so tax-free growth, quite efficient contribution, so tax relief on contributions into pension schemes. You can effectively invest in property, but specifically commercial property. So it's not to do with residential property. This is exclusively for commercial property. Now, of course, with interest rates being so high, we keep hearing about commercial property being quite a maybe golden opportunity for some if you can get in. But of course, it's not necessarily for everyone. But if you were, say, had the money to invest in property and you didn't want it in your name, maybe you're a higher additional rate taxpayer. Of course, if you haven't the pension scheme, it can grow tax-free, the income and capital gains generated from it, all tax-free because it's in your pension wrapper. Now, a bit of curious tax planning here would be if you, say, set up a pension scheme for buying a commercial property, say you're a business owner, you can effectively finance a property, say a factory or maybe an office, and you buy the property and then you lease it back to your company. So effectively your company is renting a business from a third party, which is your pension, paying rent into your pension, and you own the property in your pension scheme, so that income is tax-free. However, that you get the corporation tax deduction, say if it's a limited company that's leasing this commercial real estate from your SIP. So effectively you're moving profits from your otherwise taxable income from you as an individual or you as a corporate into a pension scheme tax-free, and that can be quite efficient tax planning. And I think it moves on quite nicely into the more corporate stuff. So of course, when we typically think of landlords, we think of individuals. Now, potentially you might be interested in limited companies as an option for maybe investing in property, or maybe you already have a limited company that invests in property. Now, typically when you move property into a partnership, there's no taxable event. Whereas if you were to move property, and that could be commercial, it could be residential, non-residential. If you own a residential property and you move into partnership, then, or maybe you are already in a partnership, say with your brother or sister. So if you own a property jointly with someone, it could be argued to be more of a partnership. Now, what's curious is you could look at, if you were to, say, move the property into a limited company, there would be stamp duty and capital gains to consider. So why do that when if you had a business partnership, which was for the purposes of investing in real estate, you could run it as a partnership and then benefit from something called incorporation relief. Now, what incorporation relief does is you envelop the company or the assets that you use in your partnership. So you go from the limited liability partnership to a limited company, and you effectively move the business assets. Now, it's a very, very lucrative bit of tax planning because it requires a lot of prep. It's not something you can just do overnight. There's a lot of work that needs to be looked at. So, for instance, the criteria about what it is you're moving into the partnership and then the limited company. It's not just a case of, I and my friend down the pub own a property jointly, 50-50. Let's look at this, because it might not apply to everyone, but where it does, you could see extraordinary tax savings in the realms of millions of pounds potentially, because a lot of property has increased in value purely just because of inflationary increases. So say you owned a property portfolio back in the 90s, you don't know what to do with it. If you sell it, you're going to realize a huge capital gain. If you gift it, huge capital gain. So what do you do? Well, you could defer the gain to the company, of course, using this structure we mentioned. So incorporation relief, effectively, you will not pay tax until you sell the shares of the company that you've then incorporated. So you go from owning a property yourself into owning an asset, such as a share, in a company that then owns the property. So of course, when you sell the share, there's a gain, but when you don't sell the share, there's no gains to consider. Now, you could effectively defer the gain indefinitely, and that tends to be what most people do. You may be able to delay paying capital gains tax if you transfer in return for shares. So that's this incorporation relief. And in order to qualify, of course, you need to be sole trader or in a business partnership. Now, the partnership needs to be sort of run in a business fashion. So, of course, you could do it husband and wife, for example, but it has to be, again, that careful planning around how that partnership operates. So, for instance, a deed of partnership or partnership agreement, how that sort of gets structured. Now, the transfer from the business and all of the assets in return for shares of the company. So effectively, you're moving 100% of the assets in partnership into the limited company. Now, let's say you are maybe someone who didn't know you needed to file tax returns, or maybe you are sort of afraid to come clean. There are processes to effectively amnesty programs, which will enable you to report any missing years. So say you are a landlord and you've been a landlord for the last 20 years, but you never knew you had to file a tax return, or maybe you never made a profit. You didn't know you needed to file a tax return. Now, you can go through these processes. We help our clients all the time with these sorts of things. It's just bringing your affairs up to date. There's limited penalties, no statutory penalties. So there's a bit of interest, of course, on any tax paid for when it should have been paid, but there's no further prosecution, and you can sort it out within 90 days with HMRC. So once you notify HMRC you want to come clean, you have 90 days to then release all your records and show everything, and we assist our clients with this. It can take quite a while to, of course, if you say missed out 20 years of tax returns for your property portfolio, of course, it can take a bit of time to get that done. But once you've done it, it's a one-off exercise, and then you can start moving forward, filing tax returns, and importantly, start claiming some of these potential planning opportunities that we've laid out. Now, I'm just going to pass you over to my colleague, Netsai. Now, Netsai is our private client solicitor, and she works very, very closely with us, myself and Mitch here at Fusion Tax. Netsai, over to you.
Thank you, Henry, and thank you everyone for joining us today. So I'll be talking about inheritance tax, but perhaps I'll just give you a short introduction. I am a private client solicitor. My specialism is wills, probate, trusts, lasting powers of attorney, and estate planning as well. So, of course, I've place on the slide some of the general rules regarding inheritance tax, which I'm sure you all know about. And I'm sure you're aware of us all having Nil Rate Band allowance, which at the moment is 325K. And there are potential allowances which may also apply to property, such as the residential Nil Rate Band allowance, which I'll discuss a bit later on. However, broadly speaking, above those allowances, you potentially would pay about 40% inheritance tax, and this is obviously applicable to your estate. The rate of 36% is applicable where you, for example, give 10% of your estate to a charity or a number of charities. So again, as you may already be aware, there are exemptions where you give the whole of your estate to charity or your spouse, and IHT wouldn't apply. Broadly speaking as well, you would potentially pay IHT on lifetime gifts, and these may be gifts to trusts, companies, closed companies, and also there may be taper relief available if you give outright gifts during 7 years prior to your death. So the taper relief will obviously be calculated on how long you've survived giving the gift out. So for example, if it's 3 to 4 years, then there'll be a taper relief allowance available to you there. So business property relief, I'm sure again we might know the general rules that are applicable to business property relief. However, the main qualification for business property relief is obviously you must have relevant business property. One of the interesting aspects of business property relief is that it can be applicable internationally. So when applying it internationally, we'd obviously need to look at the domicile rules as well as the deemed domicile rules as well, alongside that. So all of this is basically on a case-by-case basis. However, broadly speaking, your estate may benefit from 100% relief, or where that's not available, 50% relief. And of course, the minimum ownership requirements also apply. And again, broadly speaking, these are 2 years. There are some exceptions. For example, the business property relief can apply where you replace business property. So for example, a direct replacement from selling one business property to purchasing another. However, most of the notional ownership rules actually apply on death. So sometimes it is actually beneficial for a person to pass away and for the person who inherits the assets to then benefit from the relief entirely. And this is why it's important to seek advice and speak to tax advisors or solicitors during your lifetime to find out whether or not your assets may qualify for the relief at all. There are obviously automatic exemptions as well, which I'll list a bit later on. However, moving on, as I mentioned, the business property relief can apply internationally, and this is unlike agricultural property relief, which is limited to agricultural property within the UK, the Channel Islands, and the Isle of Man. However, for business property relief, we're all aware that you would need to own a business. This could be a sole trader, for example. However, there are obviously some conditions which need to apply. So, for example, the legislation clearly states that the business must be otherwise run for gain. So this might be applicable to those who, for example, are running the business as somewhat of a hobby. So what HMRC would want to know is whether or not the business has been profitable for the 7 years prior to the death in order for it to actually qualify or fall within the remit of being known as a business. Likewise, you could potentially gain the relief if you had an interest in the business itself. So this may apply to people who just, for example, might have some unquoted shares. And unquoted shares don't always need to be unquoted shares with voting rights. So they can actually qualify for business property relief. And this might be of interest to people like yourselves who may have, for example, your children as shareholders. However, they may not have any voting rights attached to those shares. When it comes to securities such as loan notes, however, those do need to have some kind of voting interests attached to them. So it's worthwhile for you to speak to a tax advisor to see whether or not the company securities actually qualify for business property relief. With 50% business property relief, the quoted shares do need to be have a controlling interest attached to them. And where you have land or business and machinery or plant machinery, then you need to also be aware that if, for example, you are leasing out the land for commercial gain, it may not qualify for business property relief. And where the land or buildings, for example, are held within a trust, then you would need to also seek advice on whether or not the assets themselves would qualify for business property relief, being that there needs to be an interest in possession usually attached to the land or buildings in use. So it's worthwhile speaking to a solicitor such as myself to see whether or not an appointment would need to be done in order for example, the assets to be put outright into the business owner's name in order to fully qualify for business property relief. Again, all of these things are on a case-by-case basis, so please do speak to us and we can go through the particulars of your particular business in order to see whether we can help. Next, we'll talk about the exclusions, which I mentioned to be broadly speaking, where your business is dealing wholly or mainly with prohibited activities, such as dealing with securities that are on the main stock exchanges, as well as dealing with land and buildings. So this obviously applies to a lot of people who are professional landlords, for example, and that is the sole purpose of their business. And also the thing to be aware of here with regards to the exclusions is that if, for example, you have surplus cash sitting within the business, it may not qualify entirely for business property relief, as HMRC will like to take into consideration how much cash you need to actually run the business, provided obviously it doesn't fall within these exclusions. So it's worthwhile speaking to a tax advisor or solicitor to find out how best you can manage your money or the money sitting within your business during your lifetime in order to take advantage of the reliefs available to you. Again, as I mentioned, speak to us if you'd like to discuss potentially putting business property relief assets into a trust. It's always advantageous for you to make sure that business property relief is utilized by passing on the property itself to people who might be non-exempt people. So as I mentioned before, spousal exemption applies when it comes to inheritance tax. So it may be wiser, obviously, to take advantage of the relief by passing on the business property to your children, grandchildren, and other lineal descendants as well, who may not benefit from the exemptions. And then moving on, when speaking about lineal descendants, we're just going to refer to the residential Nil Rate Band allowance. As I mentioned, we have the Nil Rate Band allowance, which is 325 at the moment, and the residential Nil Rate Band allowance is 175k, and it's been frozen until I believe it's 2028. So, and if you were to die in the current tax year, for example, then your estate could potentially benefit from an extra allowance in order for you to obviously not pay 40% on 40% tax on the assets within your estate. So when we are referring to residential Nil Rate Band allowance, of course, it refers to residents that you're passing on to your lineal descendants, who may be your children, your grandchildren, and other remoter descendants. This, however, does not include nieces and nephews, and sadly, it doesn't include children or grandchildren who might be from your cohabitee partner. Interestingly, however, you can claim the relief for adopted children or children who are foster children, and children whom you have actually been a guardian for, even though they may be adults at the time of your death. So it does provide the relief to a number of people. However, if you are in a cohabitee relationship, it's worth noting that that won't apply to the children who you may consider to be effectively your unofficial stepchildren. And this is when it's obviously advantageous to take advantage of entering into a civil partnership or marriage. If you are comfortable in doing so, there are loads of tax benefits. Again, the relief only applies when there is a qualifying residential interest within the estate. So there must be a property that can actually take advantage of the relief itself. So I just gave a bit of a background regarding the increase of the residential Nil Rate Band. So it's increased from 100k to now 175k until the 2027-28 tax year, when it will be reviewed. However, what a lot of people need to be aware of is if they're combined estates, and this is obviously referring to people who are married or in a civil partnership, then you need to consider whether or not your estate might be on the threshold of 2 million, because once you exceed the 2 million threshold, the residential Nil Rate Band is chipped away and withdrawn. So it's important for those people who this might apply to review their estate during their lifetime to see whether or not there are ways in which you can hopefully keep the relief. And this might involve, for example, giving a trust to your spouse, and this could be a will trust, for example, or a Nil Rate Band discretionary trust, which you create during your lifetime. Either way, you want to take advantage of reducing your estate so that hopefully you can take advantage of the allowance when the time comes. So it's important to speak to a professional who can guide you on the ways that you can structure your estate best during your lifetime and also within your will, in order to benefit the most from all the available allowances, both the business property relief allowance, agricultural relief allowance if it applies, and of course the residential Nil Rate Band allowance. So now that I've spoken to you about those aspects of inheritance tax, I'll pass you on to the main man of the hour, who is Mitch Young, our director and founder, who's going to talk to you about various aspects regarding taxation.
Thanks, Netsai. Really good stuff. And thanks everyone for hanging in there with us. We've been discussing over half an hour on various topics of taxation. So I appreciate you all spending the time with us today. And the key thing to note, as you've probably seen, you've heard me speak about it a number of times, is that there's so much interaction between all the relevant taxes. So one decision, if you're focused on a property, let's use that as an example, you've got to look at the short, medium and long-term effect of your planning. There's different interactions with taxes. So the advice you need is very agile, and that's what we pride ourselves on. What we do here is we write bespoke taxation advice based on where you're going as a business, as a family. We draw out all the different options, all the different interactions, so you can then make an informed decision. So just to reintroduce myself, my name is Mitch Young, co-founder of the Fusion Consulting Group. Also, probably a lot of you would know me from my social media as Mitch the Taxman, the leading UK tax influencer. So please feel free to engage and follow my personal account on social media. So I'm going to be focusing my time on corporation tax and business owners and using corporate structures. Now this is, very important across landlords and also business owners, because we're seeing that corporation tax is going to increase or has increased from 19% up to eventually the 25% where it's at now. So this is important that you're looking at your structuring, what can be done in order to save corporation tax, but also have an agile corporate structure to maneuver monies around your group. So one thing we look at with corporate structuring, and one key question we get asked a lot of times, is how can I save money on extracting funds through my company? And, you know, fortunately, a lot of business owners that come to us are fast growth business owners, and they are sitting on reserves. And because they are entrepreneurial, business owners want to continually invest. So they may be structured in a way whereby they're paying themselves a basic salary, you know, let's say up to the basic rate band of 50K maybe, and then extracting funds from their reserves as a dividend. As we know, if you are extracting funds as a dividend, that will be subject to income tax. So at the higher rate of income tax, that's up to 38%. So that could be that's quite a large tax burden to pay on top of the corporation tax that you've already paid. If those business owners are looking to use, say, £100,000 from their reserves to purchase a real estate property, to purchase watch, to purchase you know, a car, whatever it may be, that they're having to extract those funds to then reinvest in another asset or another business interest. So what we look at is, can actually we amend the structure to more of a traditional ownership method, which is obviously the shareholders owning the one trading business, to look at what we call, or what's called in tax terms, as a corporate group structure. And that is essentially where you have at the top, you have a holding company, and that holding company will acquire the shares from you personally. So you end up with your holding company owning the shares in your trading business. And then from there, you can establish a number of different entities on a commercial basis. So what happens is, you know, a business owner will say they want to establish a commercial property business or a residential property business. They may look at a luxury goods business or whatever else it may be. So then you have the holding company at the top that owns all the different other entities. And some of the key benefits of structuring your business like that are that if you've got that £100,000 sitting in the reserves of your trading business, instead of paying a dividend to the shareholder, which is subject to tax, you now pay the dividend to the corporate shareholder, which is essentially that holding company. That dividend distribution, because it's to a corporate shareholder, does not result in any income tax. So you move that to the holding company, and from there you can then invest into your other business interests in a tax efficient manner. So the dividend movement up to the holding company represents no tax, and then downwards into the real estate business, again, no tax. So you could move that £100,000 rather than taking out personally within the corporate structure in a tax efficient manner and continually invest in that way, making your money work better, smarter for you, making your businesses grow in an efficient way without having to continually supplement income tax on a dividend distribution. There's other benefits to looking at your corporate structure. So if you do decide to go down the route of restructuring and potentially establishing a corporate group, there are things to look at, such as corporate group relief. So if there is a loss-making entity, you can then offset the loss against the group profits. There's other things to consider, such as the VAT grouping of the businesses, if there are, if all the businesses are VATable businesses. In order to establish this, there is a process involved with HMRC. So what happens is that you're going through a share for share exchange. You're giving up your personal shares to that of the holding company. And the benefits of doing that is if you qualify, there won't be any SDLT or capital gains tax on that share for share movement. And in order to get that rubber stamp with HMRC, you have to go through statutory clearance with HMRC, writing a detailed letter about what the transaction is about, and in particular, the commerciality of the transaction, because there is anti-avoidance, and HMRC don't want to approve these restructuring if the sole purpose is tax avoidance. Now, of course, one of the purposes is tax avoidance, but there needs to be a commercial story to your structure. And then once you've received the clearance back from HMRC, then you can go about, the company's housework and doing all the necessary bits to get that established. And this is something we do every single week. So running a bit out of time, so I'll try and speed up a little bit. The other thing that is quite prevalent on what we're doing at the moment around our business owners is share schemes. Employee ownership is becoming extremely popular, attracting great staff and retaining great employees. Business owners are looking at options. And within the UK, we have a number of different approved and unapproved share schemes. So an approved share scheme is an HMRC approved share scheme. So these are EMI, CSOP, SIPs, and Save As You Earn. All basically have different criterias that may or may not match your business. And the idea is that if you can get a share scheme approved with HMRC, but there's basically tax incentives for the business and the staff member for things like national insurance, POIE, and eventual sell. So if you're a fast growth business, you're looking at exiting, then the shares could qualify for that staff member for business asset disposal relief at 10% at the £1 million. The unapproved scheme would be something where you don't meet the conditions, or your business doesn't meet the conditions of the approved scheme, and of course they're not as tax efficient for the staff member in particular. The other area that we look at, so you've got the share schemes, and then you've got something called an employee ownership trust. And that is where you may have the whole ownership of the business within a structure called the employee ownership trust, where essentially the employees own a substantial proportion of the business via the use of a trust, which is essentially managed by the trustees. So that is a complex structure, but it can be particularly useful if you've got a business owner who's looking to exit, but has a management team in place who can actually run the company, own the shares, purchase the shares from the business owner via the employee ownership trust, and that will be very tax efficient for the owner of the business and then eventually the staff members. Often one of the key issues with that is finding a trustee, but also the financing of the purchase of shares from the owner. But there are sort of SME providers who will finance that type of deal. One thing we do a lot of at a corporate level is looking at the family investment company or a family investment structure, which is essentially, it may be at the top of the trading holdco, or as Netsai mentioned, some of the business reliefs that has to be sheltered, you may look at a separate type of company or group for your investments that is owned within a family company. and particularly if you have children, then the use of a family company could be very efficient for you in the long term, because what essentially happens is that you can grant your children shares, different classes of shares, with different voting rights, different dividend distribution rights, and essentially that ownership, whatever you may give 40%, let's say, because they already own that 40%, the overall growth of that will sit outside the estate from an inheritance tax perspective. And finally, just conscious of time, we are, a lot of our clients are often come to us around about setting up overseas, because obviously the UK and the tax rates are rising, and they may be looking commercially overseas anyway. So it's important to understand that you can't just set up a company, say in Dubai, leave it out over there, filter all your profits over there, and then pay or think you may not pay corporation tax. There is a number of anti-avoidance provisions in place. When you're thinking about doing that, it's important to look at whether you're actually going to set up a subsidiary of your company or a branch. So there's two different types of tax treatments to that, and pros and cons. And then it's about where the place of effective management is. This is like a key concept in terms of the residency provisions around where your corporate structure is. There's no actually statutory definition of effective management, so there's only guidance around it. And I've just listed a couple of points on the screen here, where essentially the meeting of the company board of directors are, the senior day-to-day management is held, all the sort of accounting records and everything are held, where the main CEO carries out his or her activities, and all these will be a factor in determining whether that entity, even though you may set it up in Dubai, but because it's linked to your UK business, if you are managing it from the UK, then HMRC could bring that into corporation tax. So, you know, careful consideration and planning needs to be adhered to when you are looking at setting up an overseas entity as part of your business, as part of your structure. It can be done, so you can have your group in the UK with an overseas entity, but you need to be able to fulfill those definitions, and for the right person, with the right business, with the right flexibility, of course. So thank you very much for being with us today and listening. We're now going to essentially give out, draw someone from who's attended today, who will win the Mitch the Taxman cap just in time for the summer holidays. So you can take this with on your summer holidays and you know, promote Mitch the Taxman, but also protect yourself from the sun. So that's so that will be quite useful. And then we will move on to some questions to finish off, be finished by 12 p.m. So just going to invite my colleagues back onto the stage. So I believe, Henry, you've got the automated random draw. So if you want to click that button and then announce who's today's winner of the cap is, lucky winner.
Yeah, well, thank you everyone for watching. I've got a name here that I've just pulled out. So don't put your email address in the chat unless you want other people to send you emails. So I will. I've got here Adam Russell. So well done, Adam.
Well done, Adam.
I will send him. You'll be getting the email afterwards with instructions on how to claim your prize. See, Mitch is wearing it. He looks incredible. But I guess we can move on to some questions. There's quite a few in the chat. Drum roll, yeah, everyone. Well done, Adam. Once again, just a couple of questions we got here. Multiple dwellings relief. Thank you, Paul, for that question. Transferring properties into a limited company. So bear in mind, stamp duty is paid by the buyer. Now, what that means is if you own your company and you are transferring property that you own 100% of to a company of which you own 100% of, effectively you're moving it between yourselves. Do you have to pay? Are you eligible to claim multiple dwellings relief? Yes, you are. Of course, it's the company, the acquirer, that's going to be paying stamp duty. So you have to make sure your company makes a claim, not you as the person giving away the property. Although invariably it's the same person. Scotland, do they have multiple dwellings relief? Yes, they do. But although it's appreciate stamp duty is called something different in Scotland, but the rules are still the same for multiple dwellings relief. So you can get that anywhere in the United Kingdom. So question, but that was a good question. Derek has a question about residential nil rate band. Netside, do you want to take that one?
Yes, so Derek has asked whether or not it would apply to the first death, which was before the 6th of the 4th of 2017, and that is correct. It's still a transferable allowance. It operates in the same way as the nil rate band, and it will be assumed that the first spouse died without using the residential nil rate band allowance, so there's potentially 100% allowance to transfer over. I have dealt with estates where both spouses have died before the introduction of the allowance, and of course the family have just not dealt with anything. And unfortunately, in those situations, there wouldn't be a residential nil rate band allowance to use. And it's also important to be mindful of the fact that taper relief, the taper provisions will still apply to both the first estate and second estate. So going back to that 2 million threshold I was talking about earlier.
Yeah, great stuff. Also, just to note, Derek, so at the moment, if assuming both married couple, both individuals in a marriage are still alive today, they can pass effectively £1 million tax-free with the nil rate band and residential nil rate band. Of course, that being then transferred over to the surviving spouse. So if one spouse died in 2010, the other still alive, they can still potentially pass up to £1 million in their estate. That was the Conservative manifesto a number of years ago to get that 1 million magic number. So that has been met, and you could do that.
Yeah, just to say, guys, I know there's been a lot of questions about whether there's going to be a recording. So there is going to be a recording of today's masterclass. So everyone will receive an email over the next few days, probably with the recording link, so you can catch bits that you may have missed. So that's no problem at all. And as mentioned, we are happy to all of us to arrange a consultation with any of you or those who are watching on the recording. If you want to get in touch with us, we can discuss your personal matters. Essentially, tax advice. Not many firms out there can deliver the agile nature of what we do and then implement. So it'd be a pleasure to help any business owners, families who are looking to structure their affairs in greater detail. You have all our screens online. Have all our email addresses on the screen, so feel free to reach out. Probably have time for one more question, and for those questions we didn't get round to, please feel free to email, or perhaps we'll email you as well. Appreciate we've been going for an hour, so probably, Henry, if you want to just pick one more question that you want to answer.
Yeah. There's a theme here about companies starting to form, and but I think I'll suggest it for those people to reach out and give us a call, and we can chat about your affairs in more detail. I think the last question I'll just say, how do I take money out of a company? Now, there's several ways you can do it: dividends, salary, all that sort of stuff. And I think the important thing to note is that usually when we advise our clients, we don't just tell you one answer. There could be a number of answers based on your circumstances. So it might be salary, it might be pension contribution. Now, you don't think about maybe taking money out into your name, you want to put it in a pension instead. I would suggest for some clients that's really useful. So I would say there is no one size fits all, but really there are better ways and there are less good ways of doing it. And as part of our advice, we'll tell you what what that might be based on your family status, whatever is going on in your family, whatever money you're looking to take out.
Yeah.
Sorry, if I could just add, Anthony, I know you've posted a question. You can just send me an email and I'll respond to you as to how your father could potentially plan his estate during his lifetime.
Yeah, thanks everyone. Appreciate everyone's time. We will be back with a masterclass session later on in the year. As part of Fusion, we're going to be doing masterclasses across areas of taxation, accounting, law, and financial planning. So please make sure you look out for our marketing. Be a pleasure, as I mentioned, to hear from as many of you as possible, even if it's feedback, positive or negative as well. So I'd like to thank Henry and Netsai for their time and wisdom, and thank you all, and wish you a pleasant weekend. And we look forward to hearing from you and seeing some of you very soon.
Thank you, everyone.
Thank you.